We've seen how many at the center of the 2008 financial collapse have fared. People who you might have thought belonged in jail have actually walked away with hundreds of millions of dollars in wealth, often received from companies bailed out with taxpayer dollars. Now let's take a look at what's happening here at the New York Stock Exchange and other large exchanges around the world. Reports indicate that small and large investors alike are being taken advantage of by high-frequency computer trading. Major world stock exchanges are being manipulated by what are called high-frequency traders. Regulators are aware of this, and the manipulative activities have been reported in the Wall Street Journal and by Bloomberg News, but there seemingly has been no corrective action taken. According to Bloomberg News, high-frequency trading dominates the markets. At times, high-frequency traders account for 70% or more of daily transactions on the stock exchanges. When I explain to you what some high-frequency trading involves, you'll wonder how it could possibly be legal and why it is allowed to continue. Some high-frequency traders are allowed to place their ultra-fast computers at the stock exchanges. They then buy data feeds from the exchanges, giving them an advanced glimpse of transactions just before they take place. For the select few who are allowed to do this, it is something like getting tomorrow's news today. The firms program their computers with highly sophisticated and lightning-fast mathematical formulas to place millions of manipulative trades that suck profits from the market. These profits are at the expense of all non-high-frequency traders who participate in the market and are akin to what is called skimming at casinos. Bloomberg News wrote all about it in a September 2011 report on market manipulation. Quote, "There are particular automated strategies that have been identified by regulators which, when carried out, are likely to constitute market abuse." Please pay close attention to what the report said next. Quote, "The Commission targets so-called layering, in which traders place large orders they have no intention of allowing to go through, and, quote, stuffing, in which traders seek an advantage by delaying data feeds to other participants." If you have worked on Wall Street, you understand that there have always been shenanigans like this, but never before has it been built into the system, and to date, there hasn't been any regulatory action to stop it. According to the same Bloomberg report, traders in Europe reportedly made $18.2 billion from market manipulation and insider dealing on European equity markets alone. That figure likely dwarfs the true extent of market abuses, as it only includes equity markets in Europe and leaves out the US and other large markets such as corporate and government bonds. Okay, so we've seen some bad behavior, and we've learned that the world of high finance is just a little out of control. Think carefully and invest wisely, but don't ignore the red flags that we've discussed.
The opinions voiced in this material are for general information only and not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and cannot be invested into directly. There are no assurances that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to effect some of the strategies. Investing involves risks, including possible loss of principal.